Hey Bowtie Nation, Joseph Hogue here with another news-related informal video. And yes, this is about as informal as I get. But today, an update to our investment into super microcomputer, ticker SMCI, one that everybody's been asking about, and why Spotify could be about to surge profits and really remake the music industry. I want to get right into that. So first, I want you to listen to this clip of music. Now, maybe it's not your type of music, but you gotta admit, it is a solid sound. It's a new band on Spotify called the Velvet Sundown. They've got 3 albums out already and millions of downloads and almost 500,000 listeners. And next, I'm gonna show you how this new unknown band could double the company's profitability and send the stock soaring over the next few years, something that even Spotify isn't talking about yet and likely won't talk about. So if you look for this in the news, you're not going to find anything about it. Behind all this is really Spotify as one of those can't cut subscriptions. Okay, we've got a family plan that would listen to it in the home and the car. I hate morning news radio, so this is something that I basically just pay without even thinking about each month. The company has grown its revenue by 17% annualized over the past 3 years, and so this is a mature industry like radio that hasn't really grown much in 50 years, but this company is growing its revenue 17% annualized as it moves from music into podcasts, other verticals now. While that growth is forecasted to slow to just 10% this year, there is reason to believe it can pop back up to 15% next year, to almost $20 billion in revenue. But then the overhang here for the stock, even though it is up 100% over the last year, has always been profitability, okay? Just because the business model means razor thin margins here. Not only does the company pay the normal operating costs, but pays close to 70% of its revenue out to the artists, to the music. So those royalty owners get 70% off the top here. It means basically a cap of 30% on profits for the platform. And after all those other expenses are paid, Spotify booked less than 5% net profit over the last year. That's down from about 7% the year before. But anyway, whatever it does, it's pretty much capped at 30% profitability because of those royalties. Now, despite that profitability, that solid revenue growth, and the status as a tech disruptor has really caught growth investors. But on a 100% return this year, stock is ridiculously expensive at 107 times its earnings. Hey, here it says 154 times price to earnings on Yahoo Finance, which proves you always need to double check these numbers, folks. But on about $6.40 in earnings. Now, in Yahoo Finance, the earnings, the sales are in euros, so you have to make that conversion, about $6.40 in earnings. The stock trades for over 100 times on that price to earnings ratio. Now, that is crazy expensive for a company only keeping $5 out of every $100 in its revenue. But here's where the Velvet Sundown comes in and how it can change everything. That band with millions of downloads and 500,000 followers, it doesn't exist. It is completely AI. This band has an Instagram page. It has tons of pictures of the band and their locations. It's all fake. It's all AI. Now, my point here isn't how they did this, so I'm not going to spend a whole lot of time in that AI part here, but I'll link to a video in the description by Matt Wolf. The video just blew my mind how they did this, because it is astonishing how easy it is to create that quality music. In fact, the video shows you how you can do it in basically 15 minutes. Not years of practice, not decades of touring or managers that steal all your money. 3 albums, millions of listeners in less time than it basically takes you to untangle your earbuds. And what I'm interested in is, if this is the direction of music, what does that mean for Spotify? Now, of course, if you follow this, if you follow the news, Spotify is going to have to pay lip service to protecting the industry and the artists from this wave of AI music coming. We've seen it in Hollywood. We've seen it all across the West Coast. People afraid that this AI video and music production is going to displace millions of people. I'm scared as shit myself, but so Spotify is going to have to, pay lip service to protecting the industry, how it's going to protect artists and still have artists have a job. The CTO, the Chief Technology Officer, recently did an interview doing that, but he also weaved in a long history of tech disruption in music to hedge that, because Spotify is going to benefit like nobody else from this. And that's because that 70% of revenue, it pays out to the royalty owners, the musicians, the artists, the producers, all those. How long until that gets cut? And the AI producers are still going to eat it up, because it takes almost no work to create that AI music. So they're going to be willing to accept a lot less than 70% of revenue. So now, instead of the company paying out all of its revenue as royalties and making that $5 on every $100 in revenue, It's making maybe 10 or 15%, double or triple its profitability. Now, again, this isn't something that's going to happen overnight, but it will happen. And Spotify is going to benefit as that royalty payment comes down, as that royalty fee competition heats up. And the big one, how long until Spotify pulls an Amazon Basics and just starts producing its own music? Okay. Anybody on Amazon knows that Amazon basically uses its data and looks for the products that it can create itself. It can produce itself with cheap manufacturing out of Asia. It just reproduces those that contracted manufacturing that other people are selling things on its platform. It does it itself and cuts out the middleman. How long until Spotify starts doing that? How long until Spotify sees that it can basically create a whole division of AI music producers, create its own music on its platform, and cut out all the artists completely? Again, this is not going to be something that's an overnight change, but it is going to happen. It is going to boost profitability and income for the company for years and drive that share price. Now, that 100% return over the last year has made this extremely expensive. Again, at over 100 times price to earnings. We see here 7.5 times price to sales. I would like to see it get down to maybe the 6.5 times. I'd say 6 times price to sales before I really start buying in. Again, I think you have lots of time on this theme. I don't think obviously it remakes the music industry with this AI music overnight, but over the next, I'd say 2 years, you are going to see a huge change in the profitability for this company. So if we can get maybe a pullback on the shares to 6 times price to sales, that is going to be about a 20% discount. So I would wait for this stock to come down to maybe about into the $550, $600 range to start accumulating it, and then just keep on buying. Nation, this is exactly the kind of investing you need to be doing. Okay, putting these unrelated news stories together and just understanding what it does to a stock before the market sees it, so you can be ahead of that trend. If you like these kind of informal, quick news videos, let me know in the comments. Make sure you subscribe to the channel so you don't miss any of them. Don't miss our Monday morning market update to get you ready for the week, all the stocks to watch. I'm going to link to a playlist with this week's update in the description, so make sure you check that out next. Now, an update everyone has been asking for. It's been a whole 2 weeks since I updated on Super Microcomputer, ticker SMCI. So, Nation, I know it can be scary when a stock drops. And if you're not watching every single video, maybe you didn't see that update 2 weeks ago. But these are long-term themes that we're investing in, and that's not going to change with one bad earnings report or headline. Okay, find these stocks and these big picture themes that we're talking about. Hold on, because they will make you a lot of money, but only if you don't get scared out of them. Okay, we started buying SMCI in that apocalyptic sell-off last year, all the way down to $18 a share, and when everyone else was panicking and selling out. And yeah, there have been some scary dips along the way. Okay, back up to 45, then below 30, up to 60, then back down to 30. Shit, man, Six Flags should have SMCI managing its roller coasters. But then holding on, buying onto those opportunities. Even after the dip, I'm still up about 30%, over $200,000. This is off about 60 grand from this screenshot, but yeah, $150,000 profits, and I bought more on that recent dip. Revenue was up 25% from the previous quarter, but investors saw that 8% year-over-year growth and freaked the hell out, especially on a gross margin or profitability that dipped 0.7%, really showing signs of increased price competition in the server space. But then if we back up, this is still a huge growth story that the hyperscalers alone are spending $365 billion this year in that AI data center buildout, much of that going into server hardware. And nobody makes servers like Supermicro with its liquid cooling and its custom solutions. Michael Stayer, the senior VP for development at the company, said recently at the KeyBank Tech Leadership Forum that SMCI has grown its share of the server space from 3.5% in 2021 to over 22% today. Okay, 3.5% to 22% in just 4 years, with a target of 1/3 the market by 2026. So next year, 33% of the server market. SMCI controls over 1/5 of the server market because its products are the best in the industry. And this is a market forecast to grow to $600 billion by 2029, according to IDC. 20% annualized growth. And besides that AI arms race, sovereign cloud and AI is becoming a national security issue, which means the data center build out and the server market growth, it's not going to slow down. So yes, competition is heating up here and bringing down profitability a little, though I'd say less than 1% hit to the gross margin isn't anything to freak out about. I think the market way overreacted to that. And no, I don't think SMCI gets to 1/3 of the server market. Okay, that competition is heating up. We know Foxconn is coming into the server market with its plant in Ohio. We know Dell, HPE both have decent servers. AMD is coming into the space. So, probably not a third of the server market. We know this leadership, the management at the SMCI loves to overpromise. The CEO talking a couple of years ago about $40 billion in sales. Overpromises, probably underdelivers a little bit, but still 22% of the server market right now. That says something. This company is growing revenue by 45% this year and forecast 25% next year. And with that baseline server market growth, just with that, you get 20% growth a year. And all you out there in the nation know, for me, this has always been about that growth and the valuation on this stock. Shares of a company growing revenue by 45% a year, trading for a price of just 1.2 times that revenue. That is ridiculously low. And to put this into perspective, you look at shares of Palantir with similar growth here, 45% revenue upside this year. Explain to me how investors can pay 116 times on that price to sales valuation for Palantir, paying $116 for every dollar in revenue, and then not think that SMCI is a steal at a price of $1.20 for every dollar of revenue. Okay, 1.2 times price to sales. That is paying $1.2, $1.20 for every dollar of revenue. How is that not a great deal? Folks, that 22% market share speaks volumes. Okay, SMCI has a real competitive advantage in servers for AI, but this is a stock that will always have a lot of fear around the shares. Hell, 24% of the shares available are still sold short, so there is always going to be those out there trying to spread that fear and profit from the dip, but I'm going to be right there buying on the dips. This stock ran up to $60 a share before the sell-off, which was a price of about 1.6 times its sales. So that price to sales valuation got up to about 1.6 times when it went up to $60. Even if it only makes it to 1.3 times sales over the next year. Okay, so 1.3 times valuation price to sales on that $38 billion revenue. It is a $49 billion market cap, or about $82 share price, an 88% return, and that is a conservative estimate. I bought more on the August drop, bringing me back to about 20,000 shares in this one account, and I'm going to continue to buy anywhere near the low 40s for this stock. Watch the video on the right next, this week's Monday market update, and be ready for the stock market news and all the stocks I'm watching this week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.